Property is an amazing way to invest money. It's a great way to build passive income, build financial freedom, and set up your retirement to be the best years of your life. Or, if done incorrectly, can be a nightmare, creating stress, uncertainty, and even financial ruin. I've spent the last 10 years of my life property investing, stressing over getting tax right. So I'm here to save you that stress and give you all the info I wish I knew at the start on a silver platter. One of the things that can mean the difference between success and failure in property investing is not understanding the tax system. Tax can seem daunting and complicated, and the subject of avoiding tax can feel dirty or unethical. In this video, we're going to go through 5 ethical, legal, clear-cut hacks you can use the tax rules to your advantage. Let's get into it. Hack number 1, the obvious things. Now, I don't want this to be a video of me teasing tax hacks to then go on and state the obvious to you. So in a few seconds, let's just go through the obvious stuff you probably already know to get that out the way. You could of course deduct all your usual direct costs to running your property business. So if your tenants are paying these, it doesn't matter, but if not, then you can of course deduct things like water rates, council tax, gas, electricity, essentially all costs associated to the day-to-day running and maintenance of the property. That includes things like your letting agent fees and accountancy fees, all the obvious stuff you probably already know. Now let's get into the grey areas. Hack number 2, repairs and upgrades. Now, of course, if your boiler breaks down and you replace it, or the roof starts leaking and you repair it, all those things I imagine you're probably thinking are fairly obvious as pre-tax expenses. But where I found confusion and mistakes occur amongst investors is not properly understanding the distinction between repairs and upgrades. So why is that important? Well, a repair is considered a revenue cost, so you can deduct those repair costs pre-tax each year from your rental profits, whereas an upgrade cost are considered capital improvements, which you can't deduct from your tax bill each year. You can deduct it from your capital gains tax when you come to sell the property, which could be tomorrow or decades into the future. So how do you assess the difference between repairs you can claim as pre-tax costs and upgrades where you can't? Well, for example, things like building extensions to the property, although you're making the property bigger and therefore renting more, those sorts of things are considered upgrades. Even things like adding solar panels or adding in ensuite bathrooms are all considered upgrades, which you can't claim as pre-tax costs. The way to simply figure out if something is an upgrade is if you're essentially adding something that wasn't there before. And therefore, if you're spending money on an upgrade, you can't deduct those costs from your annual tax bills. But of course, you can deduct those costs from any profits made from selling the property in the future. So if you're flipping the house, you're not going to have to wait too long. But if you're holding on to the property long term, you're locking in that tax saving long term as well. However, there are significant upgrades you can make to your investment property under the description of repair entirely legally. For example, anything you are replacing like for like is considered a repair. So if you're replacing a dated kitchen or bathroom with new ones, that is probably going to increase the rent you can charge and increase the value of the property, all whilst being considered a repair. The important rule you need to follow is you have to replace like for like in terms of the facilities you're providing. So you can replace a dated family bathroom as a repair, but you couldn't add an ensuite bathroom to a bedroom, for example. That would then be considered an upgrade. But let's say you did add the ensuite bathroom as an upgrade and then 10 years later updated and refurbished it to a new one, then that refurb would then become a repair because the ensuite was already there. You can apply this repair rule if you buying a property to refurbish throughout like for like to then rent. But a key thing you need to make sure is the property must have been rentable, in rentable condition, before you did the works. If it wasn't in rentable condition, then it's not considered a repair. If it is, then it is considered a repair. So being smart about how you manage repairs in your portfolio can be a really smart way of reducing your tax bill whilst adding value and rental income to your property portfolio. If you end up spending more on your repairs than you make in profit, you can then carry those losses into future years to reduce future tax bills as well. It's really important you track those costs though, assuming the tax man is going to request evidence in the future. They likely won't, but if they do, you want to be in a position where you're prepared. So if you're putting things through as repairs, you need to take photos of the before and after and keep the receipts so that it is clear you replaced one bathroom with another equivalent bathroom, for instance, and that you're separating any repair costs to that of any upgrade costs with supporting evidence, so that it is clear what the tax treatment is for each type of cost. So a good example is if you have a project that is a blend of repairs and upgrades. If you have tradesmen replace the family bathroom, for instance, but then also added an ensuite bathroom, have them provide you a separate invoice for each job, as the family bathroom would be considered a repair, whereas the new added ensuite is an upgrade. I hope that all makes sense. If you have any confusion over what you can put through as a repair or upgrade, comment the examples below, and I promise to try and answer each and every one of your comments. Hack number 3, your pension. So your property portfolio is a business, and like with any business, employees or directors of that business are entitled to up to £60,000 of pre-tax pension contributions. So even if you're the only employee or a director of your business, you are still entitled to this if you want. So if, for example, your property portfolio makes £60,000 of profit, you can either pay tax on that £60,000 of profit, or you can put as much of that £60,000 into your pension tax-free. So for example, if you put that entire 60k into your pension, that would mean you've made no profit, and therefore you would pay no tax. So although this sounds brilliant, there is a catch. Any money you put into your pension is then locked up from you using personally until you reach retirement age, which at the moment, the earliest you can claim any pension is 55. But of course, that minimum age might increase in the future. You can, however, choose how you invest money in your pension. There are certain rules, so you can't invest in residential property, for example, but you can use your pension to invest in commercial property, stocks and shares, or index funds. If you want me to make a video explaining how to invest in commercial property through your pension, for instance, just comment below and I'll think about doing it. Hack number 4, who you employ. Now, this is where things get into a bit of a grey area, but still completely legal if done correctly. Your property business can employ people, so although you're probably looking at me thinking that is obvious, what you have perhaps not considered is you could, for instance, hire your spouse or your children. Now, of course, it needs to be completely legitimate, so you can't employ your spouse to do nothing. But for instance, if your spouse assists you in managing your property portfolio, you can pay them a wage. Rather than your children getting a part-time job or a paper round, they could assist you with elements of your day-to-day running of your property business. This is particularly advantageous when it comes to family members that aren't currently using their tax-free personal allowance of £12,570 a year. So your teenager could help you with bookkeeping or interior design or anything you can think of that helps with your business, which is fantastic work experience for them. And you could pay them £12,570 a year as a cost from your business, deducted pre-tax, and they can then earn that money tax-free using their tax-free allowance. Your child can then use that money as pocket money or pay it into their junior ISA or use it to pay for things they need, even their own school fees if they wanted. You can do the same with a spouse if they're not using their tax-free personal allowance, or even with a spouse if they're earning at a lower tax band than you. It can be a really effective way to retain as much profit within your family and minimize your overall tax bill. However, there are many different formats you can apply this logic to, so I would highly advise you speak with your accountant to make sure anything you do, you are 100% sticking to the right side of the law. And finally, hack number 5, the easy things to miss. Now, there are a lot of little things you can claim as a cost to reduce your tax bill, which are easy to miss for 2 reasons. Either you're just not aware of it, or you're not in the habit of keeping track of these costs because they seem minor. But trust me with this, all these minor costs, when added up over a year, could accumulate to thousands off your tax bill a year. So let's quickly rattle through them. Number 1, your mileage. So you can claim 45p per mile for the first 10,000 miles and then 25p thereafter per mile. So if you're driving to your properties, to B&Q, to pick up supplies, go to the letting agent, so on and so forth, you need to track those trips. Put it this way, if you accumulate just 5 miles a day on average on business miles traveling to and from properties, that would total 1,825 miles a year, which will total to £821 you can expense as a pre-tax cost. Number 2, office equipment and supplies. So if you have a work laptop, phone, printer, you can claim everything you use to help you run your property business as a cost. If you share the use of your phone between business and personal, then you need to keep track of what percentage of the use is personal against business, so you can then claim the business portion tax-free. 3, training courses. So if you're spending money on property coaching or going to property meetups, you can of course claim all those as pre-tax costs. 4, your home mortgage and utilities. If you work from home, you've got a whole range of self-assessment expenses you should be claiming for. You can claim a portion of your gas, electric, water, broadband and telephone bills as allowable expenses when working from home. You do need to obviously calculate how much of each bill actually applies to your property business. But if, for example, you live in a 5-bed house and you exclusively use one of those rooms as your office that is exclusively used for business purposes, you can then claim 20% of your annual bills. The same rule applies for your mortgage interest, but not your capital repayments. And finally, 5, any charitable donations. It feels good to give, and the sweetener to it is you can deduct it as a pre-tax cost. So there you have it. I'm sure I've probably missed other hacks that can save you money on your tax bill. Comment them below to help the community out. And before you go, YouTube seems to think you'll like this video up here, but before you click on it, please like and subscribe. It helps me out. See you over here.